Alright, so good morning. It's May 20, 2017. Thank you for attending the Ichimoku Trading Strategies webinar last week. Today we will discuss part 4, using Ichimoku with other tools. This session is recorded. I will provide you with the link the same time at the same time and as well as the notes. So let's do a review session of what happened last week. Ichimoku is a one-glance equilibrium chart because it lets users determine the medium-term and short-term bias of a position instantly. It shows the momentum, the sentiment, and the strength of the trend. Ichimoku is an effective tool for trending markets, whether the global stock market, forex market, commodities market, practically for any kind of trade. This is the Euro FX USD chart showing a trending market. This chart shows that the currency pair is bullish on the 4-hour time frame. The trend changes swiftly from an uptrend, where all Ichimoku elements are above the Kumo, to a downtrend, where Ichimoku elements are below the Kumo. And then there was a signal of change in trend or bias, and then the sentiment changed from bearish to bullish, and then we have a new uptrend once again. So it is easy to find the impending shift in bias using Kumo twists. As you know, Kumo twists happen 26 periods ahead of any impending change in price. Therefore, Ichimoku practitioners like us are warned of this change ahead of time so we could prepare for this. In an uptrend, once price drops below the Kumo, you have a Kumo breakout to the downside. This break below the Kumo is a strong sell signal because it is a signal of a changing bias from bullish to bearish. So in a downtrend, once price goes above the Kumo, you have a Kumo breakout to the upside, and this tells us a change in bias from bearish to bullish. Ichimoku is an effective tool for use in trending markets because signals are very clear. So Ichimoku is not used for ranging markets because it will create many false signals. So I'd like to show you how Ichimoku cannot be used in trending markets. So this is again another forex chart. The USD CAD currency pair shows some sideways movements within its chart. So here are areas where the currency traded within a range. Could you use Ichimoku to profit within this range? Could you use Ichimoku signals as a way to enter and exit the market? The answer is no. Ichimoku is not effective for use in ranging markets. You would find that the Ichimoku elements within these ranges are frequently changing. For example, in trading range 1, price crossed above and below the Kijun Sen at least 5 times. What did we say about the Kijun Sen crossover signal? If price crosses above the Kijun Sen, from below, it is bullish. If price crosses from above the Kijun Sen to below the Kijun Sen, it is bearish. So in this trading range, we see that happening 5 times. Therefore, we could have been whipsawed in and out of this trade if we followed that kind of signal. The Tenkan-sen also crossed above and below the Kijun-sen with the price. In addition, there were many Kumo twists within this very small price range. Here are some Kumo twists. So if you read into this chart more closely and you are an Ichimoku user, there is one clue that this market was going to be stuck in a range. That clue is the Chico span. The Chico span had been moving sideways. If you were trading using Ichimoku, you would have had many false signals, and this would be an entirely whipsawish environment because it is trading in a range. So you were more likely to lose money than earn money because the signals are very confusing. In addition, this range is also very small, so your profit potential will probably not be worth the trouble. So after all the twists, false twists, and crossovers, the Chico span finally breaks above the range and made higher highs. So this is the confirmation of a breakout and a new incoming uptrend. This uptrend is where we could apply Ichimoku trading strategies. As long as price is above the Kijun Sen, the uptrend is intact and the trend is bullish. But once we get into a range, avoid using Ichimoku as a trading strategy. Again, thank you very much for re-registering. I was not able to access my previous account, so I had to create a new one just this morning, so I apologize for that. Nonetheless, if you missed the first few minutes of this presentation, they're all recorded and I will send you the copy. Now let's review the 6 components of Ichimoku. The Tenkan-sen is the pink line. It is also known as the conversion line or the turning line. It tells you the short-term bias of the market. So if price is above the Tenkan-sen, it is bullish and has strong momentum. If price is below the Tenkan-sen, the short-term bias is bearish. Now the Kijun-sen is the blue line. It is also known as the reference line or the standard line or the baseline. The most important function of the Kijun-sen is as a measure of medium-term equilibrium. This means that if prices are too high, it will tend to return back to the Kijun-sen to restore equilibrium. If prices are too low, it will have to bounce back to restore equilibrium as well. The Kijun-sen could also be used as a trail stop. So if the price breaks below the Kijun-sen, it is bearish and one must cut their losses or take profits. So what is the next component? It's the Chico span. So the Chico span is also known as the lagging line because it's behind current price by 26 days. Or sorry, not 26 days, but 26 periods. Because Chico span can be used for the weekly chart, or all Ichimoku elements can be interpreted using any time frame. So we don't say 26 days, but 26 periods. It could be 26 days, 26 weeks, 26 months. So we count from today's candlesticks, 26 periods back. That's where we find the Chico span. So Chico span provides the range of support and resistances. Now the Senkou span A is also known as the leading or the preceding line 1. It is the average of the Tenkan-sen and Kijun-sen for the past 26 periods, but it is plotted 26 periods ahead. Senkou span B is also known as the leading line 2. It is the average of the Tenkan-sen and Kijun-sen for the past 52 periods, but it is also plotted 26 periods forward. The Kumo is the shaded area between Senkou A and B. The Kumo or the cloud is the foundation of the Ichimoku charting system. So a Senko span cross happens when the Senko span A and B cross or change positions. This is what you call a Kumo twist. So what signals do these components provide? This is the chart for RLT. The Ichimoku components all made bullish crossovers. First, you find the bullish Tenkan-sen crossover above the Kijun-sen. Next, you find a Chikou span crossover, where Chikou span crossed above the price. Third, there was a Kijun cross, where the price crossed above the Kijun-sen line. Fourth, we have the Kumo breakout. This is where price breaks above the Kumo. Fifth, we have the Kumo twist. This Kumo twist signaled a change in sentiment from bearish to bullish. So from this chart, we can conclude that RLT is still bullish because all the Ichimoku elements are telling us that we have a bullish chart. All the Ichimoku elements agree that this is a bullish security. Note, however, that changes happen, price changes happen, and signals could change anytime. Therefore, we must not be complacent. We must wait for bearish signals to happen. If that happens, then it's time to cut your losses or take your profits. But currently, the signals are still bullish, so we must hold this position or enter this position at support lines such as the Kijun-sen or the Tenkan-sen line. Currently, price is below the Tenkan-sen line, therefore we don't see momentum as of yet, but it is above the Kijun-sen line, so it already tells us that this is medium-term bullish. Now here's the chart for MAX. Again, we find all the 5 signals agreeing on the bearishness of MAX. What are these signals? You have the Tenkan-sen cross at number 1. You have the Chikou span crossover at number 2. Third, we have the Kijun cross, where price broke below the Kijun-sen. I'd like to correct this. 3 should be here. Price crossed below the Kijun-sen here. Alright, so here's the MAX's chart. These elements all agree on the bearishness for MAX. We see the Tenkan-sen crossover at number 1, the Chikou span crossover at number 2, the Kijun-sen crossover at number 3, the Kumo breakout in number 4, and a Kumo twist in number 5. All these elements come together to tell you that MAX is a bearish security. Even before that price breakdown happened, Max already warned us of the changes when price was at the top. So if you have seen these changes, you wouldn't have been stuck into this position, or you wouldn't even have tried to purchase any shares while the price is below the Kijun-sen. Now let's look at all these components and how they warned us of the bullish breakout for IMI. So IMI had been stuck in a trading range since October 2016 until February 2017. The Chico span was inside this price range for 5 months. The prices were below a very thick Kumo. This was a bearish Kumo because the Senkou span A was below the Senkou span B. Therefore, this is a very bearish Kumo. A long green candlestick or a bullish candlestick appeared here in number 1. 26 periods ahead, we see the Kumo twist. So at that time period in number 1, where pretend that these remaining candlesticks are not there yet and we are still at number 1 candlestick, on that day, we see a Kumo twist occurring while that long bullish candlestick was being formed. At this candlestick, price broke above the Tenkan-sen and the Kijun-sen at the same time. The Tenkan-sen crossover also happened. This candlestick was your trigger. So the market followed through with strong buying days later, and there was a Chico span breakout that created a new high for the time period. So this was candlestick responsible. This is number 1. And this was the candlestick that happened 26 periods later. So this was the new trading range formed after the Chico span broke out. So when prices break above the ranges, they often come back and retest the previous resistance as support. In the same way, the Chico span creates the boundaries for the trade by also retesting its previous resistance as its new support. So the Kumo is now bullish because the Senkou span A was above the Senkou span B. So this was the new trading range after the Chico span broke above its range. And then it made another breakout. There's another price breakout, another Chico span breakout that created another trading range. And then we have one breakout after the other. Another breakout here and here. So at this time, IMI is still trending above the Tenkan-sen line, which means that it is in a strong momentum upward. The strength of this trend is also highlighted by the Chico span, which had gone up almost vertically. So as long as the Ichimoku elements are above the Kumo, including the price, this will still remain on an uptrend. You just have to watch for bearish signals moving forward. But yesterday, IMI made a bearish candlestick. However, despite this bearish candlestick, price is still above the Tenkan-sen. So if you're a momentum trader, you would wait for prices to break below the Tenkan-sen, and then you will take profits. If you're a position trader, your support line would be the Kijun-sen. You would wait for price to break below the Kijun-sen before taking profits or before taking money out of the trade. So this ensures that you are still in the trade despite the many corrections that come your way. So for IMI, we are still in a strong uptrend unless the Kijun-sen or Tenkan-sen is broken. So you have to know these signals and make sure you're able to apply these signals in your chart so that you can anticipate these kinds of moves. IMI had already made a huge profit from its base at 6 pesos. It is now at 10 pesos. So that's more than half. That's more than a 50% gain already. All right, so let's proceed to part 5 of this lesson. We discussed parts 1 to 4 last week. So part 5 is all about using Ichimoku with other tools. We will talk about trading multiple time frames, using Ichimoku with technical indicators to find divergences, using Ichimoku with the Fibonacci ratio, and then provide some trade examples. So let's go to the multiple time frame analysis part of our lesson. This is the time frame selection chart. So firstly, you'd have to know what kind of trader you are or what kind of trade you want to get into. Do you want to trade the market for a very short time within the day? You want to buy and sell within the day? If so, you're a scalper. Scalpers make several trades within the day. Trades sometimes last for 10 to 15 minutes or 5 to 10 minutes. These are very fast trades on very volatile stocks. You want to take advantage of small movements, small, for example, 2 to 3 fluctuation movements. You're in and out within a few minutes or a few seconds. If that is your trading style, then you are a scalper. Your chart time frame would be 1 minute. So set your chart to a 1 minute time frame, but you must confirm your bias with a 30-minute chart. What does this mean? You enter and exit your trades using the 1 minute chart, but before you even think about getting into that trade, you have to make sure that the security is bullish in the 30-minute chart. So we're only talking about bullish charts here because we are not able to short the Philippine stock market. So let's focus on bullish biases. If a chart is bullish on the 30-minute time frame, so set your time frame to 30 minutes. Do you see that all the elements are above the Kumo? Are all elements above the Kumo? Is price above the Kijun Sen? Is there a Tenkan Sen crossover above the Kijun Sen? Is the Chico span above price? If so, then you have a bullish chart. So you have the 30-minute chart telling you that you're bullish, and so we use the 1 minute time frame to enter and exit the trade. So I'd like to show you an example using our Investograms chart. So let's choose a very volatile security, for example, AGF. This was yesterday. AGF made a strong move yesterday. So let's add the Kumo, the Ichimoku cloud. So what do we see on the 30-minute chart of AGF? At this price point, it was at 311. It was bullish. The day started, yesterday started with a price of 270. So let's go to yesterday's opening. This was yesterday's opening. It was, no, this is not yesterday's opening. I couldn't quite see the dates using, if I go full screen, so um, let's exit the full screen option. This was 9:30. This candlestick was 9:30. This was at 9:30 a.m. yesterday. So at this point, for example, the market had not opened yet and you're still looking to get into AGF, you'd be looking at this area here. This was the closing, yes, the on Thursday. This was the closing on Thursday. It closed at 371 or 372. So you find that on Thursday, the price had already been trending above the Kumo. This is the 30-minute chart, right? And you also see that at the closing of Thursday, the Chico span was above the price. It broke above the price. Here's the Chico span, and this was the price of previous days. So Chico span broke above the price right here. This was the closing. At closing time, the candlestick was a long green candlestick that also crossed above the Kijun Sen. So there's a Kijun Sen crossover, a Tenkan Sen crossover. In Investograms, we have different colored Kijun and Tenkan Sen. So in Investograms, the Kijun Sen is blue and the Tenkan Sen is red. In Make Trade, the Tenkan Sen is pink and the Kijun Sen is blue. So just take note of that. You will find out the settings for the Ichimoku here if you click on the settings under Ichimoku. The conversion line is a Tenkan Sen, baseline is the Kijun Sen. So look at this, that the colors are different from the settings in Make Trade, so just keep note of that. So at the closing on Thursday, the price is above all Ichimoku elements, saying that it's bullish. So at this point, on the opening of Friday, you are able to enter. So the 30-minute chart only tells you that the security is bullish, but since you're a scalper, you go to the 1-minute chart to find your entry and exit levels. So this is the 1-minute chart. So yesterday was May 19. Let's look for 9 a.m. on May 19. This is 9 a.m. 9:30 a.m. on May 19 is this line. So you're able to enter because the Chico span broke out once again. At the opening, Chico span had already broken out of its range. So you're able to enter here at any price above 372, which was yesterday's close, Thursday's close. So enter. Price made a long green candlestick. It's still bullish because price is still above the Kumo. It made a high of 438. At the closing, prices are still above the Kumo. So if you're using the 1-minute chart, you may still be in this trade until the closing because it had not made any bearish crossovers. Price is still above all Ichimoku elements. You could still opt to choose until the closing time because this is still a bullish chart. For some momentum traders, this candlestick might already be a signal to sell. This one, but we're not talking about candlesticks right now. We are talking about Ichimoku components. So discounting anything about candlesticks, this you would still be in the trade because it is still above Kumo, Tenkan-sen, Kijun-sen, and the Chico span is still within the range. So here's an example of a trade you might have gotten into using the 30-minute and 1-minute chart if you were a scalper. Now, if you're into the trade using the 10-minute chart, you confirm the bias with a 4-hour or to 2-hour chart. So if you're in it, you're a very short-term trader, but you're not a scalper. A very short-term trader trades using the hourly chart. Now, the bias is confirmed with the hourly chart, but your buy and sell signals are produced using the 5 or 10-minute chart. So let's look at another example. If you're a short-term trader, let's go back to our Investograms chart. So you're a short, what security might we use for this? Perhaps SSI. Now look what happens when I use a 1-minute chart on SSI. It is very confusing chart because unlike AGI, SSI does not move as quickly. It's not as volatile. So we use a 5-minute chart for a cleaner chart. So this is a good short-term trade example, but not a good example for scalping because SSI is not as volatile as many illiquid securities or many basura securities like AGF. So we see that in the 5-minute chart, we are bullish. So we confirm that with the hourly chart. This by default shows us the 1 hour chart. We'd like to go to the 2 hour chart for more clarity, 2 or 4 hour chart. So if you go to the 2 hour chart, go to the 120-minute chart. We go to the opening of yesterday. Yesterday at 9:30 a.m. This was the opening of May 19. This is the 4 hour chart. Just the 2 hour chart, sorry. Since our trading is only for um, 6 hours, we only have 3 bars. So this was yesterday's, but so if you're trading yesterday, you must look at the 2 to 4 hour chart of the previous day. So this candlestick is not here yet, right? Because pretend it's only Friday and it's still opening time. These 3 candlesticks are not there yet. So we look at the previous day's candlestick. We find that price is again above all the Kumo, all the Ichimoku components. It's above the Kumo, the Tenkan-sen, the Kijun-sen. In addition, at the close of May 19, price broke above or price remained above the Kijun-sen and Tenkan-sen lines, and the Chico span broke above its range. So we have a breakout at the close of, sorry, this is a mistake. This was the close of, we're looking at the wrong candlestick. This was the close of May 18, 2017. At this candlestick, May 18, we find that price is above the Kumo elements. Consistently using the 2 hour chart, starting April 21, the price was already above the Kumo elements. So we see a trend here in the 2 to 4 hour chart that the price was above all elements. And on May 18, the price was still above the Ichimoku elements. So we assume that this is still bullish. The trend is still upward. So you want to do a very short-term trade lasting hours in SSI. You use a 2 hour chart to confirm the bias, and then you get into the 5 to 10 minute chart to find out where to enter and exit. So you confirm bullish, okay? You go to the 5-minute chart. So where were we on May 18 at the close? Again, the scenario is you want to enter the trade yesterday. So here is where the price closed on May 18. This was the 5-minute candlestick on May 18, this particular candlestick. Oh, sorry, this was the candlestick. The time at the bottom is what I'm looking at, 3:25. So this was the candlestick at the close for SSI. At this candlestick, we see that the elements are still above the Kumo. So what is your entry point? At this point, price is still above the Kijun-sen at the closing, but it's not above the Tenkan-sen. So you may choose to enter at the opening the next day because price is above the Kijun-sen anyway. So you enter this candlestick at the opening the next day when price crossed above the Tenkan-sen because you're a momentum trader. So what price level is this? Is 258? No, the price here is 250. 257, 255. I couldn't see that. Yes, 256. So at 256, you enter because price crossed above the Tenkan Sen, and you just let the price run because the price is still bullish. So up to the close, you would still be holding this position if you're a position trader, but since you're a very short-term trader, you find that at the close, although you are still bullish at 262, you're a short-term trader. So it's really up to you if you want to sell this position, because usually short-term traders want to close their trades within the day. So if you're a short-term trader, this is still bullish, you can still hold it till the next day. But if you want to cash in because you're a short-term trader and you don't want to hold securities at the weekend, you would sell this. But technically, you should still be holding this because a 5-minute chart is telling you that this is still bullish. So we go back to our time frame selection chart. Short term, you can also be a short-term trader. Short-term trader has a time horizon of days. This means he holds securities for a few days. Example, 3 to 5 days. And then you want to sell. Some people sell on a Friday. Some people sell when price targets are hit. Other people sell when support is broken. So it depends on your trading style. So if you're a short-term trader, you will look at the 3-day chart to find the bias of your security, but you will enter using the hourly chart. This is because if you enter and exit using the daily chart and you're a short-term trader, you might already be late in taking profits, or you might already be late in entering the position. So you want to be able to enter more precisely. If you wait till the end of the day, you might not be entering at the optimum levels. What example can we give? Perhaps IMI. Now you're a short-term trader. No, you're a day trader. So you would look at the 3-day chart to find the bias. This is a 3-day chart for IMI. So you find the bullish trend. Therefore, you could enter this position because it is bullish. Now you look at the hourly chart for the entry and exit. So using the hourly chart, you would be entering at the Kijun or Tenkan-sen support lines. Remember that we have to find the proper level of entry. You don't just enter anywhere. What is the level? For example, here you find the Kumo breakout in this area, right? This is where you enter using the hourly chart. Then you ride the trend and keep holding the position because it is still above the Tenkan Sen. At this price breach below the Tenkan Sen, you might have been shaken out. But if you have a longer time frame, or if you have a higher tolerance for pain, you'd still be holding this because it's still above the Kijun Sen line. This is the Kijun Sen line. So sometimes the downside to using lower time frames like the hourly, 30-minute, the 5-minute, and the 1-minute chart is that price can be very volatile within the day. You could get whipsawed out of your position. Even if the price is still bullish, there are still, of course, small movements within the day that might shake you out of the position. So if you have a higher tolerance for pain, you'd be using the Kijun Sen as your support line just to be sure, because prices are often oscillating within and outside the the Tenkan-sen line, sorry, because the Tenkan-sen line is a shorter term support line. So personally, I would use the Kijun-sen line as my support in whatever time frame. just to avoid getting whipsawed in and out of the trade. So here you see that IMI made a Kumo breakout here. There's Tenkan-sen, Kijun-sen crossover, a Chico span breakout right here. So you buy the position here and keep holding. In the 3-day chart, again, we look into the 3-day chart. We see a confirmation of this bullish trend because price is also above all Ichimoku elements. So if you are trading in a short-term mindset, you would be holding the position for days. That is how you execute your trade. For medium term, you want to hold the position for weeks. Now your time horizons, example, you want to hold the position for 3, 4, or 5 weeks. You use the daily time frame for entry and exit, but you confirm the bias using the 1-month chart. So let's go back to our Investograms chart again. What security might, for example, you have Bloom. I think I showed you this example last week already. Oh no, I haven't. So you want to hold the position for days. So you look at the 1-month chart. Is this a bullish chart? And this chart shows you that Bloom is bearish because it is below the Kumo. It is bearish on the monthly time frame. However, you still have wiggle room here. Your nearest resistance is the Senko span A, which is at the 13 peso level. This is your Senko span A, 1278 level. So here, this is your area where you can still make a profit. The current price is 960. From 960 to 1270, that is still a good gain. So here you might want to measure the risk reward scenario. Your gain would from 960 to 1260 or 1270 is 3 pesos. Your loss or your risk is from 960 to 759. You have a 2 peso risk versus the 3 peso gain. At this point, the risk reward scenario might not be very good because you have a 2 risks for every 3 rewards. Nonetheless, for the purpose of showing you how to use time frames, you just know that your resistance is at 1270. So you can still make money off that. So you look into the daily time frame for entries and exits. So what is your daily chart telling you? It is telling you that you could enter your entry for the daily chart would have been here when price crossed above the Kumo. This is where you enter and you exit if price breaks below this Kijun-sen line. So you enter this trade because you know that in the weekly chart, price is above the Tenkan and Kijun-sen. However, you note that there's a resistance at 1270, so you be careful when that area comes. If you reach the point of 1270, you go back to your daily chart. And then you see whether price have already breached the Kijun-sen level, and that's when you exit. Because you're facing a very strong resistance at 1270. Now for swing trading, now this is a higher time frame. If you want to hold the position for months, you look at the 6-month chart for verification of the direction, but you go to the weekly chart for entry and exit. So you go for example, PNX. What does the 6-month chart tell you? Now, the Kumo. You could not see the Kumo because it's a very long time frame. It's a 6-month time frame. So perhaps you can just go to lower time frames. For example, 3. Let's see if we can find the Kumo in the 3-month chart. What we find here is the Tenkan and Kijun Sen. You have no Kumo, but you have the Tenkan Sen line. The Tenkan Sen line, the price is still above the Tenkan Sen line, therefore it's bullish. This is the Tenkan Sen line, the blue line, and the price is above, and the Kijun Sen is above. Sorry. And the Kijun Sen broke above its range, therefore it's also bullish on the 6-month time frame. But you look at the weekly time frame to enter and exit the trade. Using the weekly time frame, this would have been your entry if you're looking at the Kumo breakout. But if you want all the elements present together as showing bullish signals, this is where your entry would be. At this point, not only is the price above the Kumo, the Chico span is also above the Kumo. Because if you enter here, the Chico span is still below the Kumo, is still below the price. Oh, sorry, the Chico span is already above the price, but the problem is there was a Kumo resistance here for the Chico span. So you're not sure yet. The Chico span had not broken out of the Kumo at this point. But at this point, the Chico span is above the Kumo, the price is above the Kumo, price is above the Kijun Sen line and the Tenkan Sen, so your entry could have been this area as well in the weekly chart at 5 pesos. So know what kind of trader you are and what time frame you'd like to use for your trading. This sets things into perspective. Sometimes people enter the chart using the daily chart and then they exit using the weekly chart. So don't mix your time frames. Be sure to follow whatever time frame you entered the position with is the same time frame that you'll exit the position with. I'd like to show you an example using RLT again. So we want to do a short-term trade on RLT. Our time horizon is a few days. So we look into the daily chart. We use the 3-day chart as confirmation. So this is the 3-day chart. The 3-day chart shows us that price is above the Kumo. Now all elements are above the Kumo. In fact, this Chico span is already about to break out because what happens when the Chico span approaches a price bar? It either goes inside and moves sideways or it breaks above. So one of two things can happen next week. Either Chico span will break within the Kumo, within the price. If it breaks inside, then we have a sideways motion for the rest of the week. If it breaks above, then we'd have a breakout next week. So the 3-day chart tells us that this is bullish. So we are able to see the sentiment for the last 3 days. So how do we enter the trade? We use the hourly chart. So this sentiment is neutral bullish. Why do we say it's neutral bullish? Because there was a crossover happening inside the Kumo. If the crossover happens inside the Kumo, it is neutral bullish, right? If it happens above the Kumo, it's strong bullish. If it happens below the Kumo, it's weak bearish. So we find a Tenkan-sen crossing above the Kijun-sen line inside the Kumo. Therefore, we have a neutral bullish signal. However, there's some bearish element in this chart. The bearish element is that the price broke below the Senkou A. During the trading day, price had been making a good run up. It had been making an uptrend here. And then finally, it made the Kumo breakout from 77 to 79. Price stayed there for a full hour. And at the closing, it was sold down. And then price broke inside the Kumo. So we'd expect sideways action on this security because for the next few hours at least, because price is inside the Kumo, we'd get an uptrend once price breaks above the Kumo once again. So knowing this, what would be your entry level? Your entry level would be once price breaks above the Kumo. There's no entry here because price is inside the Kumo. You have to wait again above 77 to enter RLT. This is our buy point. Buy point is above the Kumo at 77. Your sell point would be when you find bearish crossovers happening once again. If price breaks below the Kumo, if Tenkan-sen crosses below the Kijun-sen, if price breaks below the Kijun-sen, then you have a sell signal. And also if the Chikou span breaks below the price. Now this would have been a sell signal to momentum traders because RLT Chikou span broke below the price at the closing. And then the Chikou span broke below Senkou A. However, the conflicting signal is this bullish crossover of Tenkan-sen above the Kijun-sen. So this is a neutral signal, so we don't know yet. We have to wait for the next bar, what will happen next at the opening on Monday. Is it going to cross above the Kumo? We buy if it does. If it crosses below the Kumo, we close the position and wait for prices to go back above the Kumo once again. So this support line that we're talking about is 72. That is the major area of support that we have to watch. This should not break. So we find that while prices are bullish on the daily chart, they're bearish on the hourly chart. So we wait for both the hourly and the daily chart to become bullish. There must be a confluence between these two time frames for a better trade, for higher chances of profit. So we have to establish a general rule that higher time frames have more significance than lower time frames. A 1-year chart where each bar signifies 1 year is going to be more significant than a weekly chart. A weekly chart is going to be more significant in its levels than a daily chart. In a daily chart, it's going to have more significance than an hourly chart. An hourly chart will be more significant than the 5-minute chart and so on. So this is a general rule that we must have to accept because it's been proven over time that market swings or movements in higher time frames will almost always affect the swings in the lower time frames. But that doesn't mean that swings on lower time frames will negatively affect the swings on higher time frames. So we only use the higher time frames to give us indications on what will be happening in the market on the lesser time frames and to confirm our bias. So for RLT, don't enter yet because it's bearish. But if you are in it for position trading, you would enter at this Kijun-sen line at 72. You notice that the support line at the daily chart is the same as the support line on the hourly chart. So you have a confluence of support levels in both time frames. 72 is the support at the daily chart. 72 is also the support on the hourly chart. So you know that this is the level to watch. Again, if you're a position trader, you'd be buying at the Kijun-sen line, assuming that because your expectation is that it will bounce. But if you're proven wrong, you have to cut and wait at 68. If it still breaks below 68, you wait at 63. But if price makes a sudden turnaround and it breaks above 77 once again in the hourly chart, you buy because it is gaining momentum, because it is above the Tenkan-sen line. To establish what kind of trader you are. So if you find the daily chart in a security is bearish and the trend is sideways to down, and price had already broken below the Kumo, you have to go short on the trade when you're trading the daily chart. So look at this chart. So for example, you find this downtrending chart. This is the USD JPY daily chart. It's on a downtrend. If you enter a position here, no, and you want to short the market, because if you're in the forex market, you will be allowed to short this. You find that the price is already below the Ichimoku elements. So this is a trade that you're supposed to short because it is bearish. So you're trading the daily chart. Your stop loss would be that Kijun-sen line right above your buy point. Now your first profit target would be at bounce level 1 or the Chico span. This is also where you find the Chico span support range support line. This is also where you find the Senko B. So price could bounce at that level. This is your first support line or your first profit target. Your second profit target would be at bounce level 2. Again, this is when you are shorting the position. Therefore, your profit targets would be below your price. It could either be at bounce level 1 or bounce level 2. Because if you look at the left, you'll find the Senko span Bs at the same level as the Chico span. Now let's look into the lower time frame, that 5-minute chart also of the USD JPY. For the same day, you find that on the 5-minute chart, the trend is the complete opposite. It is upward. However, the trend on the daily chart is downward. So would you do a short trade on this or a long trade? Would you short this because the daily chart is bearish? Or would you go long on this trade because the 5-minute chart is bullish? Of course, you must always trade your time frame. You see that this is bullish on the 5-minute chart, then you have to go long on this position using the 5-minute chart as entry and exit levels. You see that price bounced off the Kumo here. So you enter a long position at this area. And this is your stop loss level. This is the bottom Kumo. Now your first profit level would be the Kijun-sen. This is your target level 1. Your target level 2 is the Chico span. So there are two areas to take profits, target level 1 or target level 2. Again, despite the fact that this is the 5-minute time frame for a bearish chart, if you see that this is bullish on the 5-minute chart, then you should enter and exit using the 5-minute chart, and you should go long on this position because you must not mix your time frames. You trade the chart that's right in front of you. Don't go shifting. If you see time frames conflicting each other, again, you have a lesser probability of success if time frames contradict each other. Nonetheless, if you know the risks of trading a lower time frame despite the fact that it goes against the higher time frame, then you should limit your expectations because you're only trading bounces. Now this was the daily chart. This was the downtrend. And these encircled areas are the bounce points in the 5-minute chart. So notice that your bounces are very small. So your profit potential when you are trading against the general trend is also lower. So why do it? Why would you trade lower time frames if the profit potential is very low? In the previous example of Bloom, our profit potential is high even if you are trading against the trend. Because at the daily time frame, it's bullish, but since the monthly time frame is bearish, but you have a huge profit potential between 9 and 13 pesos, so that's a risk that is worth taking. But you have if you have a very small bounce expectation in the 5-minute chart and you are going against a trend, why would you enter that position at all if your risk reward ratio is not very high? So always trade your time frame. If you decide to trade the smaller time frame against the general trend, you have to know the risks. And if you enter the market using signals from the 5-minute chart, you have to exit the market using signals from the 5-minute chart. Never mix time frames. Do not enter using the 5-minute signals and exit using the daily signals. This is just wrong and you'll lose money in the end. So when you go into these types of trades where time frames contradict each other, you're actually getting into a high risk, low reward setup. So your better option is to trade with the general trend. So it all has to do with the theory of multi-timeframe confluence. If your higher time frame has a bullish bias, for example, the monthly chart is bullish and your lower time frame, for example, the weekly and the daily chart are also bullish, then you have a multiple time frame confluence. So you're trying to find the confluence between higher and lower time frames to give you the best possible entry. So this is how we pick our entries, where it reduces our risk and maximizes our potential for every trade. We don't want to be contradicting the higher time frame in the lower time frame unless we understand the risks and you want to do it anyway. And your strategy is such to begin with. Now, wait, I'd like to show you some examples of charts which have multiple time frame confluences. So let's go to our chart of PNX. This is a favorite because it had been doing a very good run lately. Now, for example, you want to hold PNX for 3 weeks as a position trade. No, so this is the daily chart. You see that it's bullish. You look at the 3-month, the monthly trade, the monthly chart for the bias, which you see that it is also bullish. So a confluence of time frames between the daily, weekly, and monthly time frame is an ideal situation. Let's go to the weekly. It's bullish as well. All time frames are bullish. Now to find the entry, you go to the daily chart. You don't want to be entering using the weekly chart because you would have to wait several weeks to get your buy point. For example, your buy point is this level. You want to enter weeks ago, you have to wait for weeks to get your buy point. If you go to the daily chart, you have a more precise entry. You enter at the Kijun-sen line. So this is at every swing, for example, you're entering here, your entry is at 7. If price went up, you wait for price to go back to the Kijun-sen level once again. Don't just enter any position here. You want for price to go to the Kijun-sen. So you have 8 pesos as your entry level, price goes up. You can't just enter in any position here. You have to want to wait for price to go back to the Kijun-sen, if because you're a position trader, right? Now, if you're a momentum trader, that's a different story. If you're a momentum trader, you would be looking at the hourly or the 5-minute chart for entry. So, using the 5-minute chart, here would be your entry levels. Here, at the areas where price meets the Kijun-sen and Tenkan-sen. Now, at this point, PNX gave a sell signal because it broke below the Tenkan-sen line. So this would be an exit signal for the momentum trader as well, because price went below the Tenkan-sen. So PNX is an example of multiple time frame confluence. Another example would be RLT. Let's go to the monthly chart for RLT. Again, we find bullish bias because price is above all Ichimoku elements. What do we see on the weekly chart? It's also bullish. Daily chart, this is also bullish. But again, if you go to the hourly chart, we're a bit bearish because price is below the Senko A. Let's look at others to go. Is this a bullish chart? Let's go to the monthly chart. To go is bullish. Weekly chart, bullish. Daily chart, bullish. Bullish still because it's still above the Tenkan-sen. Hourly chart, still bullish. This has multiple time frame confluences. Pacifica. Let's go to the monthly chart. Monthly chart is bullish because it is above the Kumo. In fact, it just broke out of the Kumo. I like to move this here. And to the right, we see a Kumo twist. So this tells you that the sentiment on a monthly basis is still bullish. It, it is bearish on the daily chart. I'll show you. Because it is below the Kijun-sen and Tenkan-sen. However, it is above the Kumo. So there's no momentum for Pacifica just yet. But the trend is still bullish because it is above the Kumo support line. And we have a Kumo twist right here. However, there's still no momentum, so expect this to move sideways until it is able to break above 62, which is the Tenkan-sen resistance line. If you go to the weekly chart, this is also medium-term bullish because it's above the Kijun-sen line, but there is no momentum because the price is below the Tenkan-sen line. So as we know, Tenkan-sen tells you short-term momentum. Now here are some charts with some conflicting signals. Felix. Let's go to the monthly chart of Felix. Felix is bearish on the monthly chart. It's below the Kumo. It is bullish on the weekly chart, but it has no momentum because it is below the Tenkan-sen. On the daily chart, it is neutral. It is bearish actually because it's still inside the Kumo. So this will go sideways. LC is bearish on the daily chart, bearish on the weekly chart, bearish on the monthly chart. So why choose trades which are bearish on all time frames? Why choose trades which have conflicting signals? If you want strong price moves, choose those that have confluences in all time frames. Recently, our best example was MAC because it was bullish on the monthly chart. and bullish on the weekly chart. And previously, it was bullish on the daily chart. But notice how price had already dropped below the momentum line lately here. So if you were trading using time frames, you would not have had MAC during this time frame because it was below the Tenkan and Kijun Sen. But recently, it made a recovery. It is again above the Tenkan Sen, so it is again bullish on all time frames. This is macro Asia. So let's go to our next lesson on divergences. For this lesson, we will use the ultimate oscillator with Ichimoku. You will find the ultimate oscillator in the Investagram's chart. You will also find this in PSE tools. These are all free charting software. They're web-based. You'll find the indicator in your call charts as well. Now, while you may use other indicators like RSI or stochastics, you're free to do so, but I use the ultimate oscillator for some reasons. The ultimate oscillator is a momentum oscillator. It captures momentum across different time frames. What happens with other oscillators like the RSI is that when a strong price movement happens, they start forming bearish divergences as the move is happening because they are stuck in one time frame. Now, the ultimate oscillator tries to avoid or correct this problem by incorporating longer time frames into the basic formula. So a buy signal is based on a bullish divergence, while a sell signal is based on a bearish divergence. We will use divergences in the ultimate oscillator along with Ichimoku to get a stronger conviction on our entries and exits. So let's review what divergences are. So when a technical indicator disagrees or moves in the opposite direction as the price action, it creates powerful technical signals called divergences. There are two kinds of divergences, regular and hidden. There are also two biases for divergences. You have a bullish and a bearish divergence. So divergences provide reversal or continuation signals. Regular divergences are signals for possible reversals, while hidden divergences signal trend continuation. So let's first talk about regular divergences. Regular divergences signal trend reversal. So how do you spot a regular bullish divergence? So a regular bullish divergence is when the oscillator is making higher lows while the price is making lower lows. Here's a video to show you. If the reversal brought about by the bullish divergence is confirmed by Ichimoku signals on the chart, then we can place a buy order on the position. So in this chart, we see that price is making lower lows and the indicator is making higher lows. So in the end, price will tend to reverse from downtrend to uptrend. Price trends down while the oscillator trends up. So we have to wait for Ichimoku signals to confirm the signal given by the divergences. I'll show you how we could use bullish divergences in this Ichimoku chart of EDC. So EDC had been on a downtrend for 1 month until December 2016. The downtrend was signaled by a Kumo twist in November 2016. This was a bearish Kumo twist. Now, all Ichimoku elements are below the Kumo. Price had been trending below the Kijun Sen, and that served as the resistance. There have been attempts for EDC to break above this Kijun Sen line, But these attempts failed. This was the first attempt. It tried to cross above the Kijun-sen line, but it failed to do so. It formed a double top. If you look at the candlestick, it tried to break the Kumo line twice at the same price level, so it was a double top. Double top is bearish, so the result was a break to the downside. Now, there's a second attempt to break the Kijun-sen line. Traders may have been faked out by this move because price actually went above the Kijun-sen and stayed there for a few days. But this price breakout was not confirmed by the Chico span. If you look at the Chico span 26 periods back, when this crossover happened, you would find that this breakout was going to fail. Why was it going to fail? The Chico span did not break above the price. It was not able to pierce above those price bars, even when the price was able to break above the Kijun-sen line. First of all, you must recognize that the bigger trend always wins, or often wins. The general trend line in this chart is down, so that is the stronger trend. Price could try to make small bounces in between. It could even try to break above its resistance. But if the volume is not strong enough to take out all the sellers, then that bounce is likely going to fail. The bigger trend often wins because it is the stronger trend. No, so apart from the Chico span not being able to get above prices, there was also no bullish Kumo twist ahead. At this point, if you count 26 periods forward from the time from number 2, when the price tried to break above the Kijun-sen, there was no Kumo twist at that area. The Kumo was still red, and it was a thick Kumo, signaling sideways movement. So we just assume, as an Ichimoku practitioner, that this market will continue to go down. So how did we spot the reversal? We spotted it using the divergence. Now, the ultimate oscillator requires 3 steps for a buy signal. First, there is a bullish divergence between the ultimate oscillator and the price. So you can see the price had been making lower lows, and the ultimate oscillator had been making higher lows. So we find a bullish divergence. Second, the low of the bullish divergence should be below 30. Look at the low of the bullish divergence in this chart. It's below 30. That black line marks the 30 level. This is to ensure that prices are at least oversold or is at an extreme condition. So the ultimate oscillator has to be below 30 to ensure oversold conditions. Third, the oscillator rises above the previous low. Now this is the high of the bullish divergence. It should be higher than the previous low, and the ultimate oscillator must make higher lows. Now that we have established that we have a powerful bullish divergence that may signal reversal from the downtrend, we look at the Ichimoku indicators. So we already found the bullish divergence. We look for bullish signals using the Ichimoku indicators. After the divergence was formed, we see the following bullish signals. We see this Tenkan-sen crossover. We see the Kijun-sen crossover, where price broke above the Kijun-sen. We have a price breakout above the Kumo. We have the Chico span crossover above the Kumo. Finally, we also have a Kumo twist that signaled the change in sentiment from bearish to bullish. This Kumo twist happens 26 periods ahead. So even before those price bars formed, after the divergence, we would already see this Kumo twist ahead of time. From then, EDC started to reverse and price trended from a low of 489 to a high of 612. It hit a strong resistance and is consolidating at this area. So you see the relationship between the bullish divergence and the Kumo elements. This bullish divergence signals a possible trend change in the same way that a Kumo twist could also signal a possible trend change. But working together, we see a higher conviction of this happening. So it's all about increasing the probabilities of the crossover of a reversal happening. Kumo twists can fail, bullish divergences can fail as well. But when you see them together in a chart, you have a higher probability of success. Now, granting that we already found the divergence, you also found some bullish Ichimoku elements. Do you just buy at any price? Can you enter anywhere in the chart because you see that it's bullish? What we want as traders is to be able to maximize our profits and minimize our risks. So we don't just enter at any price. We must find the lowest possible entry for the time period and sell at the highest possible exit for the time period. There are three things we should consider when making an entry. First, we have the level. The level is the support or the resistance line. The level is the support when entering. It is the resistance when exiting the trade. The signal is what tells you that the price will likely bounce. The signal tells you that it's about to enter the market. For example, if you see a reversal candlestick testing the support level and you find many candlesticks doing that same thing many times and bouncing off that same support level, it tells you that the support holds and you could see a bounce from that point because that level had been rejected many times. So you have a signal that the price will likely bounce. The trigger is what confirms your bias. For example, after price retests support several times, it bounces and then creates a bullish engulfing candlestick or a long green candlestick that breaks above the previous range. Then you have a trigger to buy. So the level tells you where to buy. The signal tells you. So the level is sort of like the entry, the signal. The level tells you where to buy. The signal tells you when you're about to buy. The trigger tells you to actually make that buy or to actually buy that position. So using the EDC chart once again, you see the bullish divergence. The level is the Kumo top. So this is where you buy. This is the level because you have the Kumo top as the support line. The signal is the support. This is the support at the Kumo. You see, this is the signal because the candlestick was able to hold above the Kumo. The trigger is a strong bounce off the Kumo. Along with that strong bounce, you have a break above the Tenkan-sen. So you have the level. The signal tells you that since the price stopped at the Kumo top, you have the signal that this price will continue to hold. The trigger tells you to buy because it is already out of the woods. It broke above the previous resistance and the support was able to hold. Now let's talk about bearish divergences. This is the opposite of bullish divergences. When price trends up while the oscillator trends down, we have a bearish divergence. So a regular bearish divergence tells you that the market is about to reverse from uptrend to downtrend. So in this video, we see that the price is making higher highs while the indicator is making lower lows. This tells, the indicator is making lower highs. So price is making higher highs, indicator is making lower highs. Therefore, we have a regular bearish divergence. So this tells you that the market is about to reverse from uptrend to downtrend. If the bearish signal is confirmed, or the bearish divergence is confirmed by Ichimoku signals on the chart, then we can place a sell order on the position. Now let's look at the bearish divergence in this chart. In this chart of Ayala Corp, price is on an uptrend after the bullish Kumo twist and a bullish Kumo breakout. So you have the bullish breakout and the bullish twist. Price had been on an uptrend for Ayala Corporation, and the Kijun Sen served as its support line during its uptrend. There have been attempts to break below this Kijun Sen line. However, these attempts failed. We see strong reversals from the Kumo and from the Kijun Sen line. So the Kumo and the Kijun Sen line served as supports, and we see strong bounces off those levels. We see two attempts. At this first attempt, we have the bullish engulfing candlestick. At the second attempt, we see a double bottom candlestick, and both resulted in strong bounces afterwards. Now in attempt number 3, price was not able to bounce back. Price tried to break below the Kijun Sen and succeeded. This was a bearish signal. If you look at where the Chico span was 26 periods back, when this crossover happened, you would also get a bearish confirmation because the Chico span broke below prices as well. Now we need a probability booster. We are already thinking that the price is bearish. We need to know whether we are correct by finding a probability booster. Divergences could increase the probability that the trend will indeed change from the current trend. So the current trend is upward. We find a bearish divergence because prices made higher highs while the oscillator made lower highs or common highs. So it's not just a lower high but a common high. If price makes higher highs but the oscillator is still stuck in a range so that it is not able to make a higher highs, then it is also called a bearish divergence. This increases the probability that the trend will change from uptrend to downtrend. Now we have a strong case for bearishness at this point. Now we see that the ultimate oscillator is also above 70. So there are 3 steps to a sell signal. Now, 3 steps to a sell signal. First, we have a bearish divergence that forms between the oscillator and the price. This means that price is making higher highs while the ultimate oscillator forms a lower high. So that shows that the momentum is weaker. The bearish divergence tells you that the momentum of the move is weaker. Second condition for a sell signal is that the high of the bearish divergence is already above 70. This makes sure that prices are somewhat overbought and at extreme conditions. In our chart, the oscillator is already too high. The third condition is that the oscillator falls below the low of the bearish divergence. So this confirms the reversal because the RSI started making lower highs. Again, we see a bearish divergence here and a double top pattern. Aside from the Chico span, there is also a bearish Kumo twist in the future here. There was a Tenkan Sen and Kijun Sen crossover right here. Finally, price broke below the Kumo. And then a strong downtrend followed. So we see that bearish divergence working with the Ichimoku elements. There's a strong possibility of a drop because we see not only the bearish divergence, but also all the other Ichimoku elements telling you bearish scenario ahead. Now, the bearish divergence helps boost our conviction of a reversal to the downside, along with the bearish Kumo twist and other bearish Ichimoku elements. If you're selling this market short, do you sell at any point since you're expecting a downtrend anyway? The answer is no. You need to identify the points at which you have less risk and higher chances of success. So determine, again, the level, the signal, and the trigger. So you see the bearish divergence right here. What are the levels, the signal, and the trigger? The level is the resistance level at the Kijun Sen. This is the best level to sell because it is below the Kumo, and therefore price is already bearish. It is also the level which will act as resistance to any bounce. The signal is a set of bearish candlesticks that failed to break the Kijun Sen to the upside. The trigger is the long red candlestick that confirmed that price resistance is going to be strong. So if you were shorting this market, you could hold on to your position until you find a reversal signal. Now here's another example. We have the New Zealand dollar yen, the NZD-YEN currency pair, where first we find a bullish divergence that signals a reversal. This is a regular bullish divergence. Then there was a Kumo breakout. There was also a Tenkan-sen crossover and a Kijun-sen crossover, as well as a Chico span breakout. Prices started to trend upward. Now there's also a Kumo twist 26 periods ahead. However, despite the price uptrend, it made a bearish divergence. This was the first bearish divergence. And then it made another bearish divergence. This is what you call a multiple bearish divergence, when you have several bearish divergences happening in a chart. You would find that at the second divergence, the price also made a double top. The double top is a bearish pattern. It's a bearish candlestick pattern because it shows reluctance of bears to push anywhere above that point, above that previous top. So this increases the likelihood that the price will drop from these highs. Bearish Ichimoku signals also appear along with this bearish divergence. What are these signals? First, there's a Kumo breakout to the downside. Second, there's a Kijun-sen crossover and a Tenkan-sen crossover. Third, there was a Kumo twist. Fourth, Chico span broke below price. So, with the divergence as a probability booster, we will be able to assess with high certainty that the direction of the market will be downward. Right, so we've already discussed bullish regular divergences. We talked about regular bullish and regular bearish divergences. Let's talk about hidden divergences. Hidden divergences signal the continuation of a trend. If your existing trend is bullish, a bullish hidden divergence tells you that the uptrend will continue. If your existing trend is bearish, a bearish hidden divergence tells you that the downtrend will continue. These hidden divergences happen at correction or consolidation points within the uptrend or the downtrend. So hidden divergences are the trend follower's best friend. Hidden divergences tell you continuation of a trend. So it happens when price is making a higher low, but the oscillator is making a lower low. Here's an example. This is price. It's making a higher low. The oscillator is making a lower low. This is a hidden bullish divergence. Hidden divergences help boost the probability that the trend will continue. If the hidden divergence happens at a support or turning point, then we have a level. If this level is confirmed by a number of candlesticks bouncing off the same support area, then we have a signal. If we find a bullish candlestick at that point from bounce point from support, or some bullish crossovers occurring at that area, then we have a trigger. So I'd like to illustrate this using the globe chart. Here we see price making a crossover above the Kijun-sen. The Tenkan-sen also made the crossover above the Kijun-sen. This is a bullish signal, and this bullish signal is confirmed by a price break above the Kumo. There's also a Chico span crossover and a bullish Kumo twist. Now, as price moved within the trend, you find that price made a small triangle or a pennant pattern. You would like to add to your current position or enter a new one at the proper levels. You want to enter at the best possible price. You also want to enter at the best possible time. So these are two things that a trader holds valuable: price and time. You do not want to buy into a position only to end up waiting for weeks for it to move. You also do not want to buy at prices where you will end up cutting huge losses because you did not enter at the proper level. But how do we enter? You buy at the Kijun-sen level because this is where price had been bouncing off. This is your level. Now, price bounces off the same support line twice and then makes a doji. We also find a bullish hidden divergence at that area because you have lower lows in the oscillator and higher lows in the price. Your signal is the doji. It was a rejection at the support area. The doji shows indecision. And then you have the trigger. The trigger is a violation of the indecision by a green candlestick above the doji. So there's additional probability that we could use to know if price will continue on its uptrend. This warrants us to buy at the support level. This is the bullish hidden divergence. So at this point, we see that the price is making higher lows while the oscillator is making lower lows. There is disagreement between the price and the oscillator. The hidden bullish divergence adds conviction to our entry. So after the trigger, price continued to trend up. It was using the Kijun-sen as its support line on the way up. And then price consolidated once again. We find another bullish hidden divergence at this area. Now we re-enter or add positions and just continue to hold until we find bearish signals. Now what is a hidden bearish divergence? It occurs in a downtrend. It is when price makes a lower high, but the oscillator is making a higher high. A hidden bearish divergence signals that the price will continue with its downtrend. So when you're shorting a market, perhaps in the future when you're allowed to short sell this local stock market or when you're trading other markets, you always want to trade with a trend. You also want to maximize your profits. So when the market is on a downtrend, look out for bearish hidden divergences. Bearish hidden divergences let you ride the trend longer despite consolidations in between. Consolidations or corrections might shake you out because these form patterns which are opposite the bigger trend. But if you're able to spot hidden divergences, you will be able to add to your conviction to hold on longer. Here's an example of a hidden bearish divergence illustrated. This is price making lower highs. This is oscillator making higher highs. This is a bearish hidden divergence. The major trend is down. Now, like we said earlier, when the Ichimoku elements are below the Kumo along with the price, we have a strong downtrend. So until we find reversals like a Kumo twist or Kijun-sen, Tenkan-sen crossovers or Chiku span breakouts, we assume that the current trend, which is downward, will continue to happen. So let's look at some examples. You have a bearish Kumo. And you see several price ranges making lower highs. And you see the oscillator making higher highs. So what we have here are multiple bearish divergences. Sorry, multiple hidden bearish divergences. So bearish hidden divergences tell you that the trend will continue to happen. Therefore, price will continue to drop. Now we look at the other Ichimoku elements. We see that they're also bearish. First, there was a bearish Chico span crossover. Second, there was a bearish Kijun and Tenkan-sen crossover. Third, there was a bearish Kumo twist. Fourth, there was a bearish Kumo breakout. Now, what is your level? Your level is the Tenkan-sen resistance zone. So if you're looking to short this trade, you find your level, which is the Tenkan-sen resistance zone. Your signal is the rejection at the resistance. And your trigger is the bearish Kumo break. So these three tell you where to enter your positions if you are shorting this market. Now, at the end of the trend or at the bottom of that trend, after those bearish hidden divergences, you find that price stopped dropping. Price made double bottoms or same lows, while the oscillator made higher lows. So what do you call this? This is a regular bullish divergence. This signals a change in sentiment from bearish to bullish. What happened next? We find bullish signals from Ichimoku elements. You have a bullish Kijun-sen crossover, bullish Tenkan-sen crossover, and Kumo breakout, and a Chico span breakout. And then prices started to trend up from there. Now let's look at some examples of divergences. Currently in our charts using our Kumo chart and Investograms again. So let's look at AGI. So can you find the bullish divergences in AGI? Let's add the ultimate oscillator. Find the bullish divergence. Where's the bullish divergence? It's a big bullish divergence. You can see that price made lower lows while the oscillator made higher lows. This is easier to spot in a different time frame. It's not as evident in the daily chart, but if you look at the weekly chart, it's very evident. See the bullish divergence right there. daily chart, it's not as easy to spot. So what do we see after that bullish divergence? We see bullish Ichimoku elements, price breakout, Kumo twist, break above Kijun and Tenkan-sen, Chikou span breakout above price and Kumo, and then price went on to make an uptrend afterwards. What are other examples? SLY. Some PXP first. These are current charts, so you might want to consider them for your next trades. Here is a very obvious bullish divergence for PXP. So even before you see those Ichimoku elements, the bullish divergences already warn you of a possible change in trend. So once you find divergences, just wait for confirmation in the Ichimoku elements to enter the position. You find bullish Kumo twist here, price breakout above the Kumo right here, and crossovers, and a Chikou span break above the prices 26 periods back. So this gives you a bullish scenario for PXP. SLY. Where is the bullish divergence in this chart? Find the bullish divergence. Is there a bullish Kumo signal? None yet. So this tells you to get ready for a possible trend change. If you find Ichimoku elements signaling you of a trend change, especially if you see the bullish Kumo twist, because Kumo twists happen 26 periods ahead, you would be able to prepare for this position. You can start accumulating this position when you see bearish elements happening in the chart. APX. Can you find the bullish divergence in this APX chart? Here's that obvious bullish divergence. You have the same lows for the oscillator, but lower lows for the price. So that's still a bullish divergence. And then you find a Kumo twist right here. Crossover right here, but there's no bullish Kumo breakout yet. Here we see a Chikou span crossover. So that adds to the bullishness of this chart, the probability that it will do a bullish reversal. CPM. Where's the bullish divergence in CPM? It's very clear. So that you're not caught by surprise when a price starts to trend up. You already know ahead of time that this will happen. You're able to buy ahead of the crowd because you see the bullish divergence and the Kumo twist and Ichimoku elements working together. What else are bullish? You have, I think it's P-Core. Where's the bullish divergence? You have a big one right here. Bullish divergence, and then we have a Kumo twist. And then right here, Chikou span broke above the price. Currently, it's already in a trend because there's a Kumo breakout here. It's already in a trend. I explained previously in Bukaka that There's a huge disequilibrium in this chart because price is so far away from the equilibrium lines, the Tenkan-sen and Kijun-sen, and I am expecting this to do a uh, correction, whether in price or in time. A correction in price means that price will drop towards support. It will drop towards the Kijun-sen or Tenkan-sen line. A correction in price means it will do a sideways movement, perhaps be stuck in a range until these two are able to catch up with price. So currently, this is the range for P-Core. Nonetheless, it's still bullish. Now, I'd like to show you an example of the bearish divergence that is supported by the bearishness of Ichimoku elements. Where's the bearish divergence in this chart? The bearish divergence was also confirmed by the bearish Kumo twist, the break below the Kumo, the Chico span break below the price, the Tenkan-sen and Kijun-sen crossovers. Another example is CHP. So where's the bearish divergence in this chart? There's your bearish divergence. This was followed by a Kumo breakdown or Kumo breakout to the downside, break below the Kijun and Tenkan-sen, the Chico span break below the Kumo or the price. So you could also use the same on the Forex market. This is the Euro FX USD. We find multiple bearish divergences that signal reversals of trend from bearish to bullish. Multiple bullish divergences that signal reversal of trend from bearish to bullish. So here is a set of multiple bullish divergences. And then we have the crossovers happening and price trending above the Kijun-sen line. If you want to enter the market, you enter at the support zone, which is your level. The support zone is the Kijun-sen line. The signal is a rejection at the support line. The signal tells you that the support will likely hold. The trigger is the long green candlestick that followed after. And then we find the bullish hidden divergence as well. So this increases our conviction that we are entering at the right position at the right time. However, right after our uptrend, a bearish divergence started to form, and the Ichimoku elements also confirm the bearishness. So we ride the trend until it bends. We must always be looking for signals to buy or signals to sell. So you have to monitor your charts regularly to find signals that it is about to reverse. Now let's go to our next lesson. Do you have any questions on this particular lesson? You can type them on the questions box at the GoToWebinar control panel. So lesson 3, using Ichimoku with the Fibonacci ratio. Fibonacci ratio or Fibonacci ratio is based on the Fibonacci sequence. This is Leonardo Fibonacci. His Fibonacci ratio is a method of technical analysis. The Fibonacci ratio is used by traders in trading the markets. Fibonacci retracement is based on a method wherein you're able to determine the support and resistance levels using Fibonacci levels. We use horizontal lines to indicate areas of supports or resistances. This is calculated by locating the high and low of the chart. It is measured from the high of the chart to the low of chart, or vice versa for reverse Fibonacci retracements. After a significant move up or down, the new support and resistance levels are often at or near their support lines. So I'd like to show you this chart of nickel. This shows the price range from June 2016. So I use the highs and lows of the time period. And I plotted the Fibonacci levels from the low to the high. So after nickel made a run from its low near 4 pesos to its peak of 850, price dropped significantly, but it bounced at the 61.8% Fibonacci level. However, on its way, it made several bounces, so prices don't just drop without making bounces. These were the bounces. Bounce number 1 was at the 23.6% Fibonacci level. Bounce number 2 was at the 50% level. Bounce 3 was at the 61.8 Fibonacci level. Now bounce 3 is the golden ratio. 61.8% level is the golden ratio because securities often bounce at that level. It is supposed to be a strong support level. Now if the market is to remain bullish, this has to make a strong bounce from here. If the bounce fails, we are looking at the 78.6% Fibonacci level next. Fibonacci levels are support and resistance points. So when price bounces at the Fibonacci level, it uses the higher Fibonacci levels as resistance. If broken as support, it becomes resistance. So you see that price bounced off this level, and then it bounced off this number 2 level and used the previous Fibonacci level as resistance. It bounced off the 3rd level and used the previous Fibonacci support as its new resistance. Now we could combine supports and resistances as provided by Fibonacci levels with the supports and resistances that we find on Ichimoku charts for probability boost. If we find confluences or common areas of supports and resistances between Ichimoku elements and these Fibonacci levels, then we could assume that this is a strong support or resistance level. That level should be used in making entry and exit points. Here's how we combine Ichimoku and Fibonacci retracements. Now, if you bought some shares of X at this low, you're looking for a price where you could sell your shares. So you will plot the areas where the price of X might encounter resistance. Previously, we discussed how the Chico span marks supports and resistances. We also know that previous supports become resistances. So the first resistance was near the 1030 peso level. This level was marked by the Chico span previously as resistance because it was also support on October 2016. At the same time, this was the area where you find the Senko span A. If price breaks above this level, the next resistance is near the 12 peso area. At that area, you will find the Chico span gravitating within that range as well in September 2016. You would also find the Senko span B at that area. The Senko span B is a long-term resistance line. Therefore, this is a strong resistance. Now, where is resistance 3? It is at the 1450 area. Again, you would find the Chico span at the left, where it was the support in August 2016. You would also find the Senko span A at that area. If price breaks above this level, the next resistance is near the 1650 area. This is resistance 4. There was a Chico span range in July 2016. The Senko span B is also located at that level. So you see how Senkus, whether span A or B, are areas of support and resistances. And often, if you look to the left, you find the Chico span gravitating towards a price range. Therefore, price is trying to establish this area as a support or resistance level. Now, the next slide shows the same chart, but it includes the Fibonacci levels. When you plot the Fibonacci levels in reverse, from the low to the high, you will find reverse Fibonacci levels that tell you resistances as well. Note that I plotted the candles from body to body. When plotting Fibonacci numbers, you have to be consistent. Either you plot from the body of the candle, from the low of the body to the high of the body, or from the wick of the low to the wick of the high. Don't mix wicks and bodies. You have to plot from body to body or from wick to wick of the candlesticks. So what do we find in this chart? This chart shows supports and resistances using Fibonacci levels. Resistance 1 is at the 10 peso area at 10.07. This is 23.6% Fibonacci level. Again, we plotted in reverse because we want to find resistance levels from the low to the high. So we want to know when X bounces, where will we find resistance? Until where will it bounce? Or what are the areas that are going to be hard to break? So remember that we said that supports and resistances are not exact levels, but are areas. Now at resistance 1, we find the 23 Fibo as well as the Senko span A close by. So it is in the same area as a 23 Fibonacci level. This area approximates the resistance level where it is located in the previous chart. So previously, if you look back on the previous chart, you would find that the same resistance level is found at the 23.6% level. Now, the resistance 2 in this chart is located at the 38.2% level at 12 pesos. This is also where the Senko span B is located. So this was the resistance in the previous chart. Resistance 3 is at 15 pesos. In this chart, it's 14.93, so it's in the same area. This was 61.8% Fibonacci reverse level. This is located in the same area as the Senko span, identified in the previous chart at 1450. Resistance 4 was at 17 pesos at the 78.6% Fibo level. This is resistance 4. Again, this was at the same area as Senko span B at 1650, where we only used Ichimoku elements to find supports and resistances. So we know that the Ichimoku system also lines up with the Fibonacci ratio. So when you're looking at retracements, you can look at these flat tops and bottoms of the Kumo or the Senko spans A and B, and know that it's probably lining up with a 50% or a 61.8% retracement level or the 38.2% level. So the Fibonacci levels are also good levels for you to look at on retracement. If the Fibonacci level lines up with the Senko spans A or B, then we consider that as good support or resistance levels. So is that clear? I'll show you another example. So in the previous chart of X, we've used reverse Fibonacci levels in confluence with Ichimoku components to find confluences of resistances after a security bounces. This allows us to find sell areas or areas where we could exit the market when we are swing trading. In the next chart, we will still use Fibonacci levels along with Ichimoku components, but we will use them to find strong areas of support where we could enter the market for swing trades. What we want is to find support levels where we can buy at strong areas and resistances where we could sell. Support 1, after the bounce after price falls from the top, we find support 1, which is near the 24 peso area at 38.2% Fibonacci level. This is also the same area where we find the Senko span A. So this is our buy area. This is a strong buy area because we find several supports in this area. Now when price bounces, like we said earlier, a previous resistance level is the Fibonacci level on top. So this is the 23.6% Fibonacci level near 27. So this is the area where you also find the Senko span B, and is therefore your resistance and an area to sell because it's got confluences of Ichimoku and Fibonacci at that area. Now, remember that we said that support areas and resistance areas are not exact levels. After hitting that resistance, price falls again. Since it breached below the 38.2% level this time, where it previously bounced, we find a lower Fibonacci level as support. At the 2150 level, we have the 50% Fibonacci level and this Senko span B, which could be a bounce point. It made a small bounce. Again, we sell that bounce. The price bounced at this level and we sell the bounce at the next Fibonacci level on top. Price bounce at 50 Fibonacci, so we sell at 38.2 at the 38.2% Fibonacci level on top. Again, this is also where we find the Senko span A in confluence with Fibonacci. This is that level. Now price went down again because, as we said, the general trend is very strong. The stronger trend is always dominant over, the bigger trend is always dominant over the smaller trend. So price drops again after that dead cat bounce. The next strong support where we find confluence between the Fibonacci and Ichimoku is at the 78.6% Fibonacci level at 1546. This is also where we find the Senkou span A along with the 78.6% Fibonacci level. The bounce at this level was weak. Now when price breached below that level, that same level became its resistance. So we find in this chart levels of support and resistances as offered by confluences between Ichimoku and Fibonacci. Confluences just tell you that these levels are going to be strong, either as support or as resistance. Now I'd like to show you some trade examples. Let's look at the chart of MPI. So we will plot reverse Fibonacci levels for MPI. Let's look at the smaller picture here. So we can use it for the big trend or even for the small trend. So we plot reverse Fibonacci because we want to know until where price will bounce. We don't need a oscillator at this time. We're only talking about Fibonacci. So price bounced off this level, right? For example, you're one of the lucky ones who are able to buy at this level. You want to know where to sell. Where do we find strong confluences? We find resistance here of the bottom Kumo, but it didn't have any confluence with the Fibonacci. So we assume that this is a level to break, but it would not be as strong as the 650 level, because the 650 level is where you find not only the 50% Fibonacci, the 50% level, but also this red line, which is the Kijun-sen line. Kijun-sen line was here at this level. So price broke above both at the same time, but it was not able to sustain its breakout. Price started falling and oscillating within that area for the next 6 days. So it took 6 days for price to break that area because it was a strong resistance level. At this area, we also find this. This is the Senkou span A. Sorry, it was a Senkou span B. This one. The bottom of the Kumo was also here. So the Kijun-sen was resistance here. The 50% level was resistance here. And the Senkou span B was also at the same area. So this is why prices tried to break above that 5 times before it was successfully able to break above it. In this candlestick here, price finally broke out. This green candlestick. And then prices trended above the Tenkan-sen line. However, remember again, we said that previous resistance becomes support. So when price failed to break, well, price broke above the Kumo, but it started consolidating sideways from there. And if we extend this level, we find that prices again use that level as support level. Price dropped and then bounced back above that 650 level. So resistance became support. Currently, MPI already made a bullish Kumo twist, so we are bullish at this point. After this consolidation, we might see MPI resuming its upward trend. So if it does resume its upward trend, can you guess where it might find its next resistance? It's at this 679 level will be the next resistance level. It's a resistance level because of it is the 78.6% Fibonacci level. But as of now, we still do not have any confluence with Ichimoku because the Kumo just started to twist at this area. It takes time for this Kumo to build up right here. So we will find the confluences of resistances when the Kumo starts to build up. Now let's look at IS. Last week we talked about how to find resistance levels using the monthly chart. I'd like to show you once again. I remember I mentioned Fibonacci levels back then, but I said it was a topic for this week. So I'd like to show you again this this IS chart using the monthly. We see confluences. Let's remove that Fibonacci first. If after price bounced from this level, this low, we find that price made after price bounced at this level, we found that price found resistance at this area because this is where the Kijun-sen line was. This was the monthly Kijun-sen resistance on the monthly chart. So this was a strong area to break. Apart from that, we also find there's a Fibonacci level at that area. We see that this is also where we find the 50% level. So you can draw Fibonacci levels both ways. You can draw it this way if you want to find up to where price might bounce. I'm sorry, if you want to find where prices might bounce. For example, you're at this high at this area. You're here. You want to find where to pick up IS. You use Fibonacci levels to find out where it might bounce. It bounced near the 78 Fibo area. And when it bounces back, it found resistance at the 50% area. You can use this style of finding out where resistances are. In this area, you find a confluence of resistances. Here, Kijun plus 50%. Another way is to find bounce areas is by using reverse Fibonacci levels. In this area, we don't find a confluence between 50 and Kijun-sen level, but we find that when we draw Fibonacci levels this way. So nonetheless, if you look at reverse and full Fibonacci, reverse and non-reverse Fibonacci levels, and the classic Fibonacci levels, the levels almost always line up anyway. If you make a reverse Fibonacci here, you would find that they're very close to each other. 63, 64, 51, 54 for the 38.2. Sorry, I plotted it wrong. I think I have to reload this because let's go to Annie, for example. Annie chart shows the resistance levels for Annie currently. The monthly chart shows resistance at this 722 level, which is the Senku B in the monthly chart, right? This is the next hurdle for Annie. This is a flat Senku level, therefore it's a magnet to price. So price will go to that level, but it will encounter resistance at 742. Now if you plot Fibonacci once again, we have the monthly chart. No, we'll do it smaller time frame. You can use the bigger time frame, or the smaller time frame will give you more exact representation. Well, it will give you the short term resistances rather than if you plot the entire trend from top to bottom. This will give you more exact references. So what do we find here at the 722 level? This is in confluence with which Fibonacci level? The 50% at 732, which is close to the Senku resistance at 747 or 742. So this is bound to be a strong resistance because it has two confluence between Ichimoku and Fibonacci. Now I'd like to show you some special charts which have no resistances on top. The monthly chart of RLT has no more resistance on top. However, what's keeping prices from moving up further? This is what's keeping prices from moving up further. There's no resistance in Ichimoku, but it couldn't get past the 23.6% Fibonacci level. While we consider this level not a well, it's a strong Fibonacci level to break because any break above that is signals extreme bullishness. But there's no Ichimoku element stopping this from going up, so this is less strong than if we had a confluence of other Ichimoku elements here. So you only have the Fibonacci to break, and then we have a strong move upward to follow. Now, if we look to the left, there's a historical Chico span level here. Historical Senku B line. This level is a strong long-term resistance. This is at 105. So if price does break above that 83 level and then that 96 level, this would be the next strong resistance, or perhaps the near-term target or the medium-term target at 106 if it breaks above the 83-cent level. The same goes for Pacifica. Pacifica has no resistances above its monthly chart, but you will find resistance at the Senku B level at 14. So there are no other resistances at this level. But if we do a Fibonacci plot, again, it's up to your discretion if you want to plot the entire picture or just a part of the Fibonacci or a part of the chart. It's your discretion as a trader. So your resistance, Senku B resistance is 14, but the one close by is Fibonacci 50% level at 1356. So this could be your resistance zone. Again, reports and resistances are not exact points, but zones. So keep those confluences in mind when plotting target prices or resistance areas or support areas. So it's 11:47. I'd like to ask you, do you have any questions for me? How to plot Fibo? How to plot Fibo? So let's remove these Ichimoku first, so we won't. How do we plot Fibonacci levels? So for example, let's pick an easy chart first. Yeah, this is quite an easy chart. So you want to know, for example, the price of your security starts dropping, right? You are at, and this is much cleaner. For example, your price is at this level. You plot, you want to know where you can pick up the security. Price is dropping, you want to know where to pick it up. So you plot the Fibonacci from the left to the right, from the price low to the price high. You drag, you click the Fibonacci tool here, Fibonacci retracement tool, drag from the left to the right. You get the low, drag it to the high, extend it like so. So what do we find? If you don't look at these levels first, for example, this level is not here yet. Pretend you're just here. You want to know, where could price bounce. So your bounce area would be any of the Fibonacci levels. It could be here. If price breaks below that, your next support level is here. If price breaks below that, your next support level is here. Now, what you have to know about Fibonacci is that they vary in terms of their strength as support and resistances. The strong resistance is at 61.8% Fibonacci level. So you can see prices sliced below 23.6% level like hot knife to butter. It dropped quite quickly. At 38.2% level, it found some sort of support. It dropped below 50%, but it bounced strongly at the 61.8% level. This tells you about the strength of the security. Typically, prices bounce at 61.8, but stronger securities would tend to limit their bounce to the 38.2% level. Now, this is part of another webinar that I provide my students. The 38.2% level and above is the bullish area. This area is the bullish area. The area below 61.8% and below is the bearish area. So this is the bearish area. And the area in between 38 and 61.8 is the neutral area. This is the neutral area. So there. So if your security only bounces at the bullish area and proceeds with its uptrend from there, you know that your security is a strong one. If it bounces at the neutral area, it is moderate. If price bounces from the bearish area, then it is a bearish security. Now, as a trader, you must always choose securities that bounce at the bullish area. Because if price bounces off the bullish area, what did we say about supports and resistances? previous resistance, a previous support becomes resistance. So if it breaks below 23.6 and bounces above 38.2%, it has only one resistance level to break before resuming upwards. It only has this. But if it continues to drop further, down and down towards the, for example, it drops toward 50% and then 61, it'll have this level to break and then this level to break. It will be a long and tiring road upward. So if you find that your security drops below the bullish area, you know that it's not a very strong stock. Now, for example, price bounces, we do reverse Fibonacci. This is when we do reverse Fibonacci because, again, reverse Fibonacci tells you where you are able to sell a security. Now, you see that price bounced. You already know that this is the bottom, right? Now, you do a reverse Fibonacci to know until where it might bounce. So you notice price was able to bounce until the 50% level right here, and then it dropped back down. It bounced until here, and then it dropped back down. Where did it find support? Found support at another Fibonacci level. It broke above again. Currently, it's still above. It's still making its way up. The fact that it broke above the 61.8 Fibonacci level, and what did you say about this level? This is a strong Fibonacci level to break. If it breaks above that, then we have a strongly trending security. It's strongly trending because the 61.8 level is a strong resistance on the way up. It is also a strong support on the way down. As we've seen in this picture, it bounced off 61, therefore, this is a strong resistance support level. On the way up, it is also a strong resistance level. So the fact that it broke above that means you're still in for more uptrend from ICT. So I'd like to show you securities which are strong based on Fibonacci and which are weak based on Fibonacci. So PNX, let's go for the daily chart so you can see it much easier. So we plot Fibonacci to know where prices might bounce. So you plot it from the recent high to the recent low. So for example, you're here, price made the high here, and then prices drop back down. You plot from the nearest low to the recent high. What do we find? When PNX was when PNX was at the 7 peso level, it retraced only until the 23.6% level. This shows us that this is very strong and it is in for more uptrend. So this shows us this is a very strong stock because it consolidated above the bullish area. Again, where's the bullish area? Above 38.6%, 0.2% is the bullish area. Since it limited the bounce to the bullish area, it made a strong move upward. And then again, we see a consolidation. We plot that again. What do we see here? Price again bounced above the 23.6 level, again above the bullish area. This is the reason why it made strong moves upward. We measure that again. So recent high to recent low, for example, this is the recent high. Again, it consolidated at the 26.6 level. So if you're a trader, you look at the consolidations. If the bounces are quite shallow, then it means it's very strong. This is why PNX just keeps going up and up and up because its retracements are very shallow. Same thing happened for IMI. Previous low, previous high. its consolidation was only until 23.6. Then it made a strong uptrend again. For example, you're here. Yeah, recent high, recent low, 23.8 again, 6 again. So this tells you consistently that you have a very strong stock in your hands. So what's the recent movement here to here? Again, still 23.6. So you're in for more uptrend. But if you're trading a stock like this, for example, what's a weak stock? For example, Vita. No, let's go for a weekly trending stock first. EDC. Is this a weak retracement or this is also a shallow retracement? The problem with this is um, it's taking too long compared to other securities. So you know this is going to do a strong upward trend, but this is a security that's taking very long to consolidate. So let's go smaller picture. In the smaller picture, we see that the bounces were at the 38.2 level. It's deeper than the PNX chart we showed earlier. We go from recent high and recent low. Now the consolidation was at the 50%. So the retracements are getting deeper. Previously, the retracement was only until 38. Now it's until 50. We go again for the next swing high to swing low. The retracement even reached until no, we'll go for this one. The retracement was still until 50%. So this is not a very strong uptrend. So from the Fibonacci retracements, you know the strength of the uptrend. So if you want to measure, an important thing to note about retracements is that, look at this chart of Vita here. The 78.6% level is an area that you should watch because prices often bounce from there. As we said, 61 is a strong support level, but if price breaks below that, the ultimate end where prices could bounce is the 78 level. You would find this in most securities if you want to trade bounces. So this happened in the big picture. If you look at the smaller picture for Vita, you would find the same thing. Price also bounced at the 78.6% level. So this is the extreme target of a bounce. It's the 78.6% level. So it's safe to pick up securities that have dropped to 78.6% levels. So again, you picked up the price here. You get the reverse Fibonacci to know until where the bounce might happen. Sorry, wrong plotting here. You find that. Price was stopped at the 38.2% level. Fibonacci levels serve as supports. They also serve as resistances. So when you do bounce plays, you always consider Fibonacci levels. So that's how you plot Fibonacci. If you haven't yet registered to Bukaka and gotten a premium, uh, the code for the premium sentiment subscription for Simple Trader, please do so. I sent you the email. You don't have to pay anything. Just get the code and I will register your name under the Simple Trader Premium. I have a tutorial on Fibonacci levels if you're part of the premium account of Simple Trader. So you can just watch the videos I have there for more information about Fibonacci. So again, please give me your code, provide me with your code for Simple Trader at bukaka.com and I will activate your account in Bukaka and you don't have to pay for anything because it's already part of the deal in the webinar. So what else do you have questions? Yeah, and also after this, we have regular Wednesday tutorials. After you register for the Bukaka Premium account, I have regular weekly tutorials, often on a Wednesday, where we discuss several topics, not just Ichimoku, we have moving averages, etc. That's part of my service in the premium account of Simple Trader, and that will be available to you for the next 3 months. If you're unable to attend, I also have recordings. So once you enter the Simple Trader premium, you can backtrack and watch all the previous recordings I made. So any more questions? I hope you learned something for today. Don't worry, we'll be reviewing and reviewing Ichimoku and the charts in Simple Trader. Some are Ichimoku, some use moving averages, etc. Nonetheless, you'll be seeing more of Ichimoku in the Simple Trader Bukaka. That's why I wanted you to be part of that after you provide the code. So if there are no more questions, I'll email you the notes as well as the link to this video. So thank you very much for attending this webinar, and thank you very much for trusting me to provide you with this tutorial on Ichimoku in the first place. Thank you to Idea School and also to Chrissy. Have a great lunch and happy weekend. Bye.